Hey, what's up guys? Omar here, broker and CEO of Alden Mortgage and Ome Realty. So this is actually going to be my 100 subscriber special. I guess in the grand scheme of things, we've become so numb to the numbers of followers by the millions and millions. You know what? At this point and each stepping stone that I have, I am forever grateful for 104 people watch or subscribe to my channel and thought that I had some value for them. Now, hopefully it grows, but you got to enjoy the journey, right? You can't jump from 0 to a million subscribers, 2 million, 3 million, whatever, just overnight. Now, I have been doing this for quite some time now. Yeah, man, you know what? It's easy to get lost in the numbers with a few things, but if you sat in a room and you saw 104 people in one room and they're watching you, that's a lot of damn people. Now, hopefully, as we continue with this videos and all this other stuff, we continue to grow. So if you did like the content, or if you do like the content, please consider liking, subscribing, commenting, all of that stuff. But on this special, on 12/1/2022, of course, we're going to do another mortgage rate update. Within that, I'm also going to debunk something here by this guy named Dave Ramsey. I don't know. It's this old guy who has a YouTube channel or whatever it is that he has. One of my little cousins, he sent this on over. And they were talking about something that's called, first of all, I hate when people say this. If a real estate agent, a majority of the time are real estate agents who do say that because they don't know any better. But if you hear the words, date the rate and marry the house, you run away from that person because that person just doesn't have your best interests in front of you. So I'm going to go ahead. There's a couple of things that, he said in his video that I'm going to go ahead and try to finagle through and try to make you understand why this is wrong. Because in order for me to go ahead and say that this is wrong, I have to go ahead and make sure that you know that it is wrong. Number one was this 5-year rule. He said in his video, you know what? Let me do the mortgage rate update. I'm going to show you the video. And then from there, I'll go ahead and touch points with each and every single one of them, tell you why. And plus, the best part about it is I own a mortgaging company. So I could actually show you what the difference would be if your home depreciated, whether it stayed the same, the price differences. We could go through a couple of different scenarios so you could see exactly what I'm talking about. So as of right now, 12/1/2022, 30-year fix will be sitting at 5.78%. 15-year fix will be sitting at 5.15%. 30-year high balance will be sitting at 5.76%. DSCR loan, which is a debt service covered ratio loan. This is a loan product to where you go ahead and use the rental income coming in to cover the debt that's going out. None of your own income, none of your W-2s. We don't care about any of that stuff. It's just going to be the property itself. This is going to be along the lines when you get into the investing side of the world a little bit more heavily. You're not going to use this right out the gate. You're going to try to go FHA, keep your total initial capital as low as it possibly could go. You're going to try to maybe do 30-year fixes. You could do 3% down payment assistance programs, but whatever. Bank statement loan. This is another loan product where we don't need your W-2s or your bank statement, or not your bank statements, but your W-2s, your pay stubs. We just go by your bank statements and we run a ratio based off of that, and we see how much you get to get approved for. That's sitting on 8.50%. FHA 30-year fix will be sitting at 5.30%. 7.6 adjustable rate mortgage will be sitting at 6.14%. USDA 30-year fix will be sitting at 5.35%. VA 30-year fix will be sitting at 5.73%. And hard money fix and flip will be sitting at 9.75%. Now, what is going to happen is, which it already has kind of started happening, when the negativity on the portfolio of each holder, servicer, or whoever he is. A servicer is the person who holds the mortgage product, right? That they're the one that you're making payments to. When there's a negative impact on big time holders, then loan limits change. Then miraculously, all of a sudden, we're going to go ahead and change our guidelines. We're going to increase the loan limits. We're going to go ahead and give you more because we're just good guys. I was probably going to start increasing high balance to jumbo, But majority, we're going to stick to the conforming side. Conforming is just with the Fannie Mae and Freddie Mac side, which that sounds so boring. So I'm going to go ahead and first, this Dave Ramsey clip my little cousin sent to me. You could take a look at it. You could see, and then we're going to go ahead and touch some points and see what exactly, he's wrong. Let's just face it, the man is wrong on everything that he says, because you cannot be speculative when it comes to things like this. You cannot for certain 110% say, you know what, this is the best time to buy, because you don't know. You haven't been doing this. You sit on your little talk radio show. I do this every single day for a living. I've been doing this for a better part of 20 years. Trust me, he is not right on this. But let's watch the video and you could go ahead and see for yourself.
And you can't usually say this, is what I'm saying.
Can't wait.
Right now is the best time to buy a house in the next 5 years. Right now. And here's why. Okay? Prices are not going to go down. Some of you are saying, well, I'm going to wait for prices to come down. You're not going to get them.
Yeah.
They're not coming down.
Yeah.
Okay? They're going to go up slower, but they're not going to go down. They may not go up hardly at all, but they're not going to go down. And so 5 years from today, houses are going to be more expensive. This is as cheap as it's going to be in the next 5 years. So this is the best price right now if you're going to buy a house. Well, interest rates are up. Buy the house. If interest rates come back down, refinance.
Yeah.
But don't not buy waiting on interest rates to come down. Just refinance the mortgage if interest rates come down. This is the best time to buy a house in the next 5 years. And here's what's weird. This is also the best time to sell a house in the next 5 years.
All right. Well, there you go. You saw exactly what he said. He stated that this is the best time to go ahead and buy. It's in the next 5 years and blah, 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 blah. Well, you can't say that. And you want to know why you can't say that? Is because the only reference that we have historically is the 2008 crash that kind of resembles this, but not really because of the bad loan products that we have. But ultimately, as a whole, right now, because of the pornography that was in the real estate business that we had in the past 2 years during this pandemic that just killed everything, it's now catching up. Now, when it comes to real estate, anything when it comes to real estate, there's a huge catch-up period, okay? I'm going to go ahead and show you exactly why I say it takes so long. I'm going to debunk his 5-year myth. I'm going to go ahead and debunk the interest rate refinance. I'm going to debunk a lot of things because in the world of mortgaging, we have loan to value that we have to worry about. We have guidelines that we have to worry about with whoever we're selling it to. We have debt to income that we have to worry about. And if your home price does decrease, does that really mean that you're going to go ahead and pay less when interest rates decrease? So if I went to 5.5 to 4.75, hypothetically, am I going to be paying less even though my home price decreases? Let's just say it's 10%. Now, for instance, Austin, Texas, home prices are already declining, right? Home prices, now there's a big catch up. We're in December 1st right now. November, December, January, it's like, this is like the low time, right? This is like when things just go completely sour. This is like when everybody in the real estate world kind of, for the most part, takes a vacation, except for me. I don't have a vacation at all, ever in my entire life. Austin, Texas has dropped 10.3%. Phoenix, Arizona, 9.9%. Palmdale, Florida, 8.9%. Charleston, South Carolina, Ogden, Utah, 8.6%. Denver, Colorado, 8%. Vegas, 7.9%. Stockton, California, 7.7%. Durham, North Carolina, 7.5%. Spokane, Washington, 7.4%. Now, these are not just the normal everyday. Like, there's still more. Like Boise, Idaho is another one of them. Here in Los Angeles, in certain pockets, because Los Angeles is so big, San Francisco is taking a huge hit. Everybody, but you have to give it time before it actually creeps up. Now, do you want to know how much total values have dropped? So we've lost relatively in total equity in homes. In everybody's home in the entire United States, we have dropped about $1.5 trillion, which is not that much. I know it sounds like a lot, but it's not that much. But if that number does, like when you're dealing with such huge numbers and you're dealing with things like this, the smallest numbers create such a big wave, right? You go from just like a beautiful day at the beach where the waves are really, really nice to all of a sudden you have these big ass waves just crashing on you to all of a sudden an earthquake hits in the middle of somewhere in the Atlantic and now you have tsunami warnings all over the place. But $1.5 trillion on equity, that means that the servicers that are holding these have lost $1.5 trillion worth of value on their portfolios. That means that the people, relatively overall, as a whole, have lost about $30,000 across the board in total value in their homes. Now, in the past 2 years, because I'm going to try to hit every point that Dave Ramsey said, in the past 2 years, what we had is we had an inventory loss, right? So our inventory for the past 2 years, that means that if I went ahead and stopped taking any listings from this day forward, so you understand what I'm saying, if from this day forward, that means that if, in like a month, if I had 1 month inventory, all the houses will be sold if we keep selling at the rate that we're going and if we don't take any listings. So during the pandemic, why everything, home prices went crazy is because we're at 0.7. That's like roughly about 3 weeks. 3 weeks worth of inventory. If we stop selling right now or stop taking listings right now as of today, in 3 weeks we will be out of homes all across the board. Now we've increased from the 0.7 to the 3.3 month supply, which is still about half of where we need to be. But we are still, we'll take at 3.3%. Now, like I said, in real estate, everything is kind of like a catching game. Now, Mr. Ramsey, year-to-year sales total in the Bay Area has dropped 37.3. We have to catch up for the home prices to drop. Because what's going to happen is when home prices, when sales drop, that means inventory increases, which you saw, 3.3% or 3.3 months. But Bay Area is at 37%. Year-to-date is 23.3%. Decline in sales, which is 2% year over year decrease in total price. Southern California is at 40.8% year to year sales. Year to date is 23.1. Overall, we've had the biggest drop at 36.9% total encompassing as a whole in the whole entire United States. Now, the only reference we have is going to be the 2008 crash that we could kind of correlate where our economy is kind of like where it needs to be. We can't really go to the dot-com bubble. We can't go back to the Great Depression because the economy was a little bit different. We're very more like heavy tech side of things now. So things are a little bit different. But what I'm going to do is I'm going to go ahead and show you exactly where we're at in 2008 because it didn't start in 2008. It's actually started in 2007 where things are declining. And then how long it took, because I'm going to go ahead and debunk its 5-year roll. And then we're going to go ahead and see exactly if you lost 10%, we'll just go 10%. If you lost 10% of the value in your home, what does that mean for refinancing if you just bought? Well, let's go ahead and see. So right here, if you see, we have the median home prices in the United States. Now this is going to go from 93 all the way until 2021, getting into the 2022, August 2022. Now, if you look over here, okay, so we were at the peak over here at 216,000, somewhere around there, back in August of 2006. That was your peak, okay? But that's not when things started going haywire because we really don't care about that one. Let's go on over to 2007. 2007 is when we started declining and it was still about 216,000. So March 2007, I want you to look at this as a staple, okay? March 2007, if you're home, if you bought, and you could go ahead and use today as your guideline and just put it like, instead of saying March 2007, say March 2022 or December 2022. If you bought at 216,000, 2007 is when everything started kind of going a little bit on the lower end. So we started dropping and dropping and dropping and dropping. And then August 2008, that's when everything went completely bananas. That's when the crash happened and it kept on dropping and dropping and dropping. And then we hit a bottom of 169,000, which is roughly about like 20-something% decline in overall value of your home, right? So if we're at 216,000 in 2007 versus the 169,000, that right there, that's when it dropped. That's when it completely went to the bottom. Look at that. That's in 2012. So you went from 2007, 8, 9, 10, 11, 12, And then let's see, when do we get back to the $216,000 again for you to go ahead and make sense to have like, break even point where you could go ahead and refinance at the same level that you were going to refinance before, because you want to go ahead and refinance at, let's say you put 20% down. That's March 2016 is when you are at the same level as you were before. So there you go. There's the 5-year rule. You're like at 7, 8 years before anything keeps coming up. And then you can't even count 2019, okay? You can't count 2019, 2020 really, because that was just, like, this is not normal. This is not normal. We want to see lines like this where it's a settled increase, but not here. Now, the second part of this is going to be if I did lose, right? If I did lose the amount, let's say I lost 10%, right? I bought a house for, I don't know, $400,000, $450,000. What's my mortgage payment difference if interest rates decreased and I bought, and I'm like, and like so you bought out of $450,000, you lost 10% value, 20% value, whatever it is. What is going to be my mortgage interest rate if I bought at a higher rate versus a lower rate, but my home price decreased? Because let's just face it, it is an inevitable thing that might be happening hypothetically. Now, I'm not going to say, 100%, because you can't. It's impossible to say 100%. That's why this guy that's talking about this is absolutely wrong in everything that he's saying. Now, he could have other reasons why he said this. Could be a backdrop that I don't know. I'm not going to take the time to go ahead and research this guy at all. I'm just going to go ahead and pick the little clip that I saw, and then I'm just going to go ahead and go from there. But let me show you, since I am a mortgage broker, I'm going to actually show you on my mortgaging platform, one of the wholesalers that we deal with, I'm going to show you exactly the difference. All right, so here's our platform. There's my name, there's your primary residence. Okay, so let's say, for instance, you are going to be at 80% loan to value, your home appraised for $450,000, which is going to put your total loan amount at about $360,000. Let's go ahead and just skip the closing costs and everything like that. So we're going to go ahead and see apples to apples. So let's get a quote on exactly with this, because we're going to go ahead and refinance first mortgage. We're just going to do a rate and term. That means we're not pulling any cash out. We're not doing anything. We just want to do rate and term off of a $450,000 house, because respectively, I think 400, not in California, but 450,000 is kind of average across the board, I'm assuming. So we're going to go to conventional. Conventional right now, oh shoot. Okay, interest rates did drop. Okay, see, this is why it's always important to lock your rate. But, all right, so at 5.5%, your total payment is going to be $2,810.71. Now, that's all subjective to where you live, because I went ahead and pre-populated some numbers right here with, homeowners insurance, your taxes, everybody changes here and there. But on average, we're going to keep it apples to apples. So we're at 80% loan to value, okay? Because this is a really big key factor. You have to know loan to value. So if my loan to value, I'm at 5.5% today. Now what if my home value drops 10%? My loan value, because my appraised value is going to drop, I'm going to keep my loan amount at $360,000. My appraised value is going to be at $400,000. Well, let's see. Wait a minute. What's so if we go 10%, let's go 90. That means we'll be at $405,000. Okay, so if my total is going to be at $405,000, and we're going to do my loan amount at $360,000, right? That's roughly about 88. Let's just go 90% loan to value. We'll just give it a little extra thing just to keep numbers even. I like even numbers. And then where is going to be our quote? So just for reference point, okay? 5.5%, we're at $2,810.71, okay? That's going to be our overall payment, because there's this little sneaky guy that's about to come up and rear his ugly head that when you drop under that 80% threshold, it becomes a little annoying because you have this thing, whether you're FHA or you're conventional. It's called insurance, mortgage insurance, property mortgage insurance. It sucks. So while this silly little thing, as you notice, I haven't been cursing so much in my videos because YouTube actually put up a bunch of different things in their algorithm. And even though I curse very heavily normally, you gotta stop cursing so you get more subscribers. I'm already at, I'm at 100. I want to keep it a little bit higher. But let's see, we're conforming 30-year. So we're going to keep things, you get a little credit on this one. Now you see this little sucker right here? 5.5%. We're at $2,881.82. I'm a total idiot, and I totally forgot what our mortgage payment was beforehand, but whatever. I'm going to pretty much assume that it's more. I'm going to go back and do that. So even if you went to 4.875, your total payment is going to be $2741.19. I got to go back to 80%. So $2741.19 with mortgage insurance. Does it make that much of a difference? Because we want to know. $2,741.19 on the 5.5 at par will be $2,881.82. This is with mortgage insurance. So the key is this rate. If I go lower with no mortgage insurance, is my 5.5 going to be cheaper than the $2,741? Let's see, 5.5 at par, 5.5. Oh yeah, it is. It's going to be at least $100 and something cheaper. So you're paying more. So I hope you're making more. A lot more. Well, not really that much. But here in California, it's going to make a big drastic difference. Let's see, conventional elite. Where is that at? Conventional elite on 4.875. 4.875, that's on with no mortgage insurance. So that's a huge difference. $2,481.30 at 4.875 with no mortgage insurance versus $2,700 with mortgage insurance. So there you go. Mr. Ramsey, please don't be speculative. It is not fair. You have such a huge platform. Don't say these dumb things that's called date the rate and, marry the home and give people hopes that something is going to be better or you think that you're right. Because let's face it, none of us are right. We don't know if it's going to go down or if it's going to go up. Especially since the Fed fund rate has been increasing. We don't know if he's going to lose his mind, if Jerome Powell is going to lose his mind, increase it another, 150 basis points. Let's say he goes crazy, it's 150 basis points. We still have increases coming. Now, are they going to start easing? We don't know. It's not fair to the people. Now, I just showed you the numbers. It's not beneficial to you. You're going to be paying more if interest rates decrease, if your home value decreases. Inventory is still low. I am not making any of this up. This is not, you could look this up yourself. This is not rocket science. It doesn't take a genius to figure this out. Yeah. Well, if I miss something, because I'm not going to go through this guy's videos and last thing I want to do is see this old dude talk about finance and stuff like that. I don't care about all that stuff. But if I miss something, maybe he has something behind his thought process. Maybe he said something behind it in another video that I'm not aware of. Maybe there's a lot of things that he says. And if you did have anything that you want me to debunk on anybody and kind of actually do numbers and play it play by play, link in the description below. Let me know. For up to 50% commission rebate, 0% listing on selling your current home or any mortgage assistance, link in the description below. And for 104 subscribers, I know I don't check it too often, but I got 104 subscribers. Holy shit. For my 104 subscribers, thank you so much. I really appreciate it. Until next video, guys. Peace.